With the S&P 500 recently moving into a bear market, we're getting a lot of questions now about where the bottom is. How much further down do we have to go before we reach a point at which buyers start to come back into the market? How can we calculate this with any degree of certainty? Well, certainly one of the ways of doing it is using technical analysis. And this is the idea where we bring in this point about cyclical analysis. And this seems to work out. Now, back in early January this year, we spoke to Andrew Pancholi from the Market Timing Report, and we were then with him to ask him about how the year was going to develop, because at that point we'd just seen a little bit of a turnaround for the S&P 500. Andy's back with us now with an update and to work out where we are on the scorecard. Andy, it's good to be able to speak to you again and to get an update on your latest thinking. On our last chat with you, as I said, it was in fact the 25th of January this year, can be seen on YouTube. You explained about your market timing report, how it worked, how it sort of dovetailed neatly within to these this cyclical analysis. And you were saying that then at any year ending in '02 was likely to be a bear market, but it was likely to end up at the end of the year than when it started. How are we doing as we just about to tip into H2?
Hey, well, so far so good. The cyclical analysis is giving us some really good clues, and we'll run through that in a moment. Right now, and certainly up to last week, pretty much everybody I spoke to was incredibly bearish. And I think what we really need to point out is if we look back, we look back super long cycles as well as sort of micro cycles. And if we look back to 1962, which is the pattern we were talking about in that interview, that we were following this pattern for 1962, not just as a market overlay, but also geopolitically. So we were seeing this build up. So for those of you who are not familiar, 1962 saw a massive escalation of Cold War tension leading up to the Cuban Missile Crisis at the back end of the year. So that's exactly what we've seen, this massive heightening of geopolitical tension. Putin has started his special operation there into the Ukraine. So what we're looking at in terms of markets, and let me share this first chart. This is the overlay for the Dow back in 1962. And we saw this pretty much waterfall decline, especially this last flash out here from June the 8th, exactly what happened this year. We got this decline. And what's really interesting is this 60-year cycle shows us that a major low came in on the 25th of June. So we're on the 60-year anniversary from that right now. And we've just seen that, this last few days has seen the S&P starting to show first signs of a reversal. And by the way, as we mentioned, you can see how this year then sort of pops up towards the back end. And this here was the Cuban Missile Crisis sort of further sell-off down in October. But the key point is that the 60-year cycle is a very important one to look out for. History repeats in 60-year intervals. 1941, Pearl Harbor, 2001, 9/11, the only two times America has been attacked on its own soil. 60 years, very prevalent in commodity markets. So the key point is that we do need to be on alert potentially for a significant low coming in here, imminently. But we can add a bit more to this scenario and go back 90 years. So we're talking, units of 30 years. We were 60 years back. Go back another 30 years to 1932. And from the 1929 crash high of 3rd September 29, the low finally came in on the 8th of July 1932. So what we're really saying is we're within 2 weeks of a significant low there from 90 years ago. So history can repeat, it often rhymes, and these are reasons for why we should be on alert for a potential important low coming in on the US markets, and therefore, it would impact the other markets as well, Jeremy.
Okay, so you've laid out the patterns that we've seen and how it integrates nicely with 2022. What about the technical analysis that you apply behind this to work out where we are now from where we've come from and where the likely support levels are from this point on?
Sure. So, of course, the big cycles just give us some clues, and we can't, manage our portfolios accordingly. So what we tend to look at is a bit of geometry and a few other factors. And what we've seen is regular Andrews pitchfork, and this line here, this upper parallel line, is key. What we have seen is that this, each time we've hit what we call the median line, the green line, we tend to see bounces, and we went pretty much up to there. Certainly on the June contract, we hit that. This is the September contract, and we've come back here. So this is a potential target area, but the key point will be this line here. This line must be breached for the present section of the bear market to be over. And I think that's a very important point to note. This is the line in the sand that we are looking for. And if this doesn't get breached, then we continue downwards using this channel. And that then, we come then to the point, well, what is the big picture? So if we take the March 2020 low and the high there in that we had the beginning of January this year, and look at the Fibonacci retracement, well, we got the very clear 38.15, 38.17 level, which caused a very smart bounce, sharp bounce there, pretty much to, I think that was within about 8 S&P points. But then we got this sort of gapping down here, and we are now trading below it. So are we going to recapture this? As I say, that previous channel I showed you is the key point. And if we do head down, the next two levels are just over 3,500 being the 50% retracement. That's going to be an important area. And then we're going to be looking around about 3,200. But if I can just take this a stage further, and we bring in the entire bull run from the March 2009 low all the way up to the high of this year, then we see something really interesting. We see the 38.2% level comes in at 3,200, just above that, 3,224. If we were to put these together, what we're going to see is this. These are the levels from the previous chart. We had the 3,196 is the 61.8% retracement of that move. And it's pretty much within 25 to 30 points or 1% off this 38.2% level. So what we'll say is that if the market does continue down, 3,500 will be important for some sort of bounce. And there'll be major support around about 3,200, I'd say, 31.96 to 32.25. So these would be the key levels to watch. And that would then just also come just inside this old top here. So in terms of charting, a significant point there, round about 3,200, Jeremy.
Interesting. And that 3,200 level is something obviously we're going to keep in mind. One other thing I wanted to catch up with you on, Andy, if I possibly can, is to go over what we were talking about at the back end of January and the political importance of this year. I think at that point you were talking about the challenge to America's position in the world. And you were talking then about the potential for political upheaval. In fact, I think you were talking about February at that point. But here we are now, well into what's three figures in terms of numbers of days we've been at war in Ukraine with Russia. So far as I was aware, there was no indication of that when we spoke. What could you tell us about the cyclical analysis and other events that occur?
Okay, so forecasting using cycles is pretty complex. We've programmed some pretty advanced systems here. And what we saw was when we spoke back then, we felt that February would be a key turning point, particularly for America, because now America's had to sort of, back whatever's been going on, and this has proven very challenging to Biden and the administration. Then I think yesterday we saw this the changes and proposals for the gun laws. So basically America is polarizing at a more rapid rate than we realize over here. I do travel backwards and forwards to America a lot, so you can see New York isn't anything near what it was 3 years ago. You do have to be slightly more careful than the last, say, 10, 15 years. So you can see that there is a degree of breakdown there. And the longer term view we have here is that America will degenerate over the next 3-4 years into some high level of polarization and a degree of, dare I use the phrase, civil war. And I think this February is a key turning point with American politics, but also, I'm not sure, I don't think we covered this, but certainly with our clients, we looked at the super long-term war cycles, and there is this pattern that comes in relating straight back in terms of time to the outbreak of the Second World War. And you project that same time cycle back and you go exactly into the Crimean War in the mid-1850s. So, and that's exactly where the conflict is right now. You know, Crimea is just south of Ukraine. So history rhymes for sure if it doesn't repeat. And these cycles we had on our radar for the last 2 years with regards to the super macro geopolitical war cycles. And what this is saying is really there is a move away. Of course, we haven't even mentioned the challenges that we're facing with China as well. The West is facing with China and the potential threat to Taiwan. And we see that August could be a significant time window for that escalating. So what we're really seeing is this massive global polarization accelerating this year. And the 60-year cycle effectively is a trigger to the much longer cycles of several hundred years that we do look at. So does that make sense? So we really do see that America is starting to lose its hold, but at the moment the dollar is strong. It has been for the last several months, because you argue it's the best house in not necessarily the best neighborhood.
Yes, it's interesting, isn't it? Political polarization, it sort of goes hand in hand with financial polarization as well. We're getting within each individual country, which is causing all sorts of disruption. Let me just quickly go back, if I can, right the way to the beginning and ask a little bit more about the market timing report, just to get your the background here, because you use your own software, don't you, to analyze these market moves?
Yes, we do. So we've created a very complex system which basically looks at mathematical patterns. And our argument is that every market has its own DNA. And if we can find the mathematical DNA between it, we tend to sort of start with super macro patterns affecting the world. So, specific markets, a typical example would be very simply the 2007 global financial crisis is one we called for our clients, based on the fact that 1907 saw the rich man's panic, and the previous cycle back from that 1807 saw the Embargo Act, and the midpoints 1857 saw crashes, and 1957 saw a secular bear market. So the idea is that history repeats at a super macro level very clear, precise patterns, and there are several of these patterns. And in fact, the grain markets, 50 years from the lows exactly to the lows that we've just seen, these massive moves, which of course been accelerated by geopolitical factors in the Ukraine. So we take these super macro factors and drill them all the way down to daily cycles. A very complex process, needs a lot of processing. And we also apply this to geopolitical forecasting, which is a very complex operation, by using key points and finding the mathematical patterns between those. The bottom line, what do we do? The market timing report, you don't have to worry. We do all the heavy lifting for you. We identify key turning points. And where we get, say, a weekly turning point aligning with a daily turning point, we will see a more significant change in trend, whereas daily turning points will create sort of reversals for a few days. So that's an easy way of putting it. It's like the wheel within the wheel within the wheel, where we see the big moves all coming together. We're able to identify potential trends beginning and ending, and we can fine tune it using the smaller cycles. What does it mean? It's all about incremental gains, helps people with their hedging and trading, when to protect positions, etc. So that's what it's all about.
Look, Andy, it's a pleasure as ever. Thanks indeed for joining us with this look there, and that price target of 3,200 or thereabouts for the S&P 500. And just a reminder, if you wanted to catch up with Andrew Pancioli, you can do so either through LinkedIn or through his website, themarkettimingreport.com.